Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bill's back again.
Andrew, we are back again. Favourite time
the Backstreet Boys.
I don't even know where to go with that, Andrew. All right, maybe we scrap this.
Back.
Maybe we scrap this and start again. What do you reckon? Okay, I'm just going to get straight into it. Andrew, what are we talking to everybody about today?
Oh, you know what's funny? Today we're talking about everything you need to know before buying your first property. And I dare say when we're talking about the demographic that is looking to buy their first property, they're probably listening to this saying, Backstreet Boys, what in the world are these guys talking about? Who is that?
Yeah. Yep. 100. Well, actually,
anyway, there you go. There's something for everyone.
Digress, really quick story. So we're over the dinner table last night. We were talking to Scarlett and she was saying, so she's 11, talking about who her favourite musicians are.
Yeah.
She listed 3 because we were talking about Taylor Swift because she used to be Taylor Swift mad. Anyway, she's not anymore because that's no longer cool. Anyway, she mentioned 3 of them. No idea who they are. I'm officially old. And Samantha
old before that.
Samantha had no idea either. Andre sitting next to her, he knew all of them.
We're out of touch, Bills. We are out of touch.
Andrew, property.
Yes. Bring us back on track.
Look, I think the first thing that I always tend to say to people, let's take a quick lesson back in history. The playbook is, buy property, grow wealth, what have you. There's the other side that we need it for shelter and what have you. So completely respect all of those. But is property actually the right thing to do? Now, that can be seen as controversial. Are there other ways to do it? Are there other ways to grow your wealth, achieve whatever goals that you've got? We're not going to have an answer because it's different for absolutely everybody. But that's probably the question that I would be asking yourself first. And probably in the same breath or the same thought bubble going, okay, am I comfortable enough with borrowing hundreds and hundreds of thousands of dollars and having a 30-year commitment to make that repayment each and every month?
Yeah.
Because it's pretty substantial when you think about it. Because if for whatever reason the answer is no, or you don't feel comfortable, well, guess what? There are other ways. Now, not that, I want to deviate from us talking about property, but that's probably the first thing that I'd say, that just ask yourself the question, is it the right thing to do for you?
Yeah, exactly right. I think that's the first hurdle to get through. I mean, if you're thinking about buying your first property, question you need to ask is, am I doing it because it's the right thing and it's actually right for me? Or am I just doing it because that was conventional wisdom and maybe that's no longer appropriate and maybe that's no longer the right strategy for me?
Which is a bigger consideration, Andrew, in this environment, because we are seeing that it's harder and harder to get into property, and you start, your working career maybe with some HEX debt, and then as soon as you get that out the way, you've gone and put the ball and chain of the mortgage around your neck. Actually, you know what mortgage means in Latin?
What does it mean?
Never know? No. That means life debt.
Really?
Yeah, or debt for life or something like that.
Which I think is maybe the perfect or the right analogy when we're talking about this, right? Because when you look at previous generations, on average, it would take people approximately 10 years to pay off a mortgage. You're now looking at 30-year terms and people are even extending that out with refinancing and all of that stuff. So I think that, when you say life debt, 100% correct.
So you pay it off just as you're about to die, or because you've got a mortgage, it kills you? It could be both.
Or maybe the mortgage is expunged because the property is sold and you've died. I don't know. Look, I think the first thing is starting to do your research. Do your research on probably a number of things. Do your research on the area that you're going to buy in. Do your research in, how much it's going to cost to get into the property that you want. Do your research in, is this going to be, an investment property or somewhere that I'm going to want to live? Really starting to get a solid understanding and not just looking at the here and now. So it can be really easy to say, I want to live that inner city lifestyle and, purchasing a 1-bedroom apartment in an inner suburban area because that's all I can afford is what I want to do. Great, that's all good and well. But understand that, maybe there's going to be some limitations on capital growth. Maybe there's going to be some limitations on, what you're going to be able to do with that property, or how long that property is going to take you through. So know what you're doing, know why you're doing it, and do your research is I guess the first thing.
Yeah. And as part of that process or thought process, one step past that is getting a pre-approval. So going to a mortgage broker and finding out what it actually is that you can borrow.
Yeah.
There's different, amounts now with different deposits. It used to be 20%, used to be 10%. The government's now introduced it's 5%, no LMI, so you can get in. The barriers to entry are a lot less. But going to a mortgage broker and understanding what that then looks like, really for two, or I would say three things. One is the most obvious: how much can we borrow? But as a translation, what can we afford to buy? That will then also tell you how much of a deposit that you need, plus in the same breath, what are our repayments going to be on today's interest rate for 30 years? And then probably more importantly, that I think is overlooked, is out of the deposit that we need, deposit plus stamp duty, if stamp duty is applicable, is how much money are we going to have left over? Because you don't want to use all of your eggs or throw all of your eggs in one basket, or use all of your ammunition to get into it, move into the property and then go, oh geez, our savings are now down to $2,000.
Yeah, and now all of a sudden you got to furnish a property, maybe do some paint or renovations, and do some things around to make it the property for you. Yeah. And yeah, you're in a real pickle. So yeah, understand how much is going to be left over, and how much do I need to be left over. Anticipate what that's going to be and budget for it. Mm-hmm. And I guess when you are considering, and we'll talk about this, as we go through the podcast as well, but just because a bank says that you can borrow X amount of money, that does not mean that you can afford to buy that amount or property with that amount of money. So, it's all good and well to say, hey, a bank's going to lend me $700,000. Mm-hmm. So all of a sudden, purchase price is going to be, $800,000. Just because a bank's going to lend me $700,000, can I afford those repayments? What impact is that going to have on my lifestyle? What impact is that going to have on me to be able to invest and grow and do things in the future? And is that actually the right thing to do? And also on the flip side, when you look at it and say, I don't want to pay mortgage insurance, so I want a 20% deposit because I'm not going to go down the route of, let's say, that 5% OLMI, whether you're ineligible or whether you want to have more funds left over or not have as much debt. But sometimes the consideration, or what we're starting to, especially in an environment where prices are rising, is I've got a 10% deposit and I want to get to 20% to avoid paying, let's say, $10,000 in mortgage insurance in this scenario. How long is it going to take me to get to 20%?
Yeah.
Is that going to take me 2 years? What's the likelihood that for me to be able to save for that 2 years to get to a 20% deposit to not pay $10,000 in mortgage insurance, will that property have increased by more than $10,000?
Yeah.
Because if it has, sometimes the right decision is, hey, let's get into the market now. Let's pay that 10% deposit. Let's pay that mortgage insurance and actually benefit from the rise in property prices, as opposed to try and chase the tail of a 20% deposit, which is always that target moving further away from you as property prices rise. And now you're in a position where you've ended up paying more for the property. Mm-hmm. And yes, you've avoided mortgage insurance, but you've still spent more.
And you've lost 2 years.
Yeah.
Yeah.
I think that mentally also does something to you too.
Yeah, 100%. Look, I tend to agree that, that may have been the case, and sort of going back to the start of the podcast about the old playbook was save 20%. It'll take you a year or two, get into the property market, pay it down, borrow against it, rinse and repeat, sail off into the sunset. It's not the case. It's not the case anymore. Property prices are a lot higher. Cost of living is a lot higher. The capacity to save is significantly lower. So yeah, I think being strategic about it, and talking about being strategic about it, there's probably a couple of other things that people can use to try and help them get there faster. I mentioned the government scheme where you can purchase at 5%, no LMI, if you are a first home buyer. There's obviously the stamp duty concessions as well too. So anything under 600 grand, you're not paying stamp duty. That then is on a sliding scale up to 750 as well.
That's in Victoria, right?
In Victoria, we are talking Victoria, but if we talk about all the other states, we're going to be here till the cows come home.
So just talking about the best state of them all. Sorry, maybe not the best state because we haven't been in a great place. So let's not.
I was gonna say that, and then I'm like, nah, I'm not going to. It used to be.
Is this time to rip on the Victorian government again, Bills?
We're just going to go in the wrong direction. We don't have a lot of time, so probably not. But so Victoria. And the other thing too, from a strategic perspective, getting back to what I was talking about previously, and even if you go back to, say, last week's episode around margin lending and using another vehicle to be able to grow your wealth, but something now like rentvesting is a lot different in terms of the strategies that are available. That never used to be a thing back then. Above and beyond that, traditionally you could buy an investment property and just rent it out using your traditional methods. Now you've got the ability to increase your rental income with things like Airbnb. So thinking about this differently, there's more options available to people as well too. They're probably just some of the other things that I wanted to throw in there about what's possible and what's capable. Probably a little bit of a different tangent, but
no, and it's relevant because I think these days people are looking at property in a slightly different lens, and you're almost forced to. So because property has, become so expensive, maybe it's too expensive to live in the area that you want to live in, and maybe it doesn't tick that lifestyle goal, but maybe purchasing property is still the right thing to do for you. So maybe, rentvesting is a consideration, and renting where you live while investing in a property in an area that's going to grow is the right thing to do for you. I mean, I guess you also need to, speak to your broker, speak to your advisor around, okay, if that's going to be the case, am I now ineligible for some of the other government grants, because a lot of the government grants are only for first home buyers and only for people that are purchasing an owner-occupied property. So, what's your strategy? Maybe it's, hey, I'm going to live in that property for a period of time and then it's going to become an investment property. But understand what your options are going to be and what your strategy is going to be, I think, is important.
Yeah, and it's not just getting into the property. Obviously, there's so much work and effort getting into it. That just gets you to the starting line.
Yeah.
How do you then get out of it? Is it just that pay your monthly repayments for 30 years? Is that what it is? It only gets you to the starting line. So thinking through what that looks like, that then comes into different options. You mentioned owner-occ going to investment, principal and interest versus interest only. That's a real interesting one as well too.
Is it interesting? I mean, for us, it's pretty simple, right?
For us, it's simple. Look, I'm of the pure belief that a product should not be made available where you don't make principal reduction repayments. So it's interesting in my mind that even exists. So I don't love it, but I understand the used case for it in the right set of circumstances. Probably not as relevant in terms of the people that we're talking to today, specifically your first home buyers, but that could potentially be an option. And where I have seen it work, and I'll highlight one example, is where somebody's had a principal and interest owner-occupier loan, and then they've had their first child and there's two incomes servicing the mortgage, but the mother of the child needed to take time off work, obviously, at that point in time, reducing the mortgage expense by moving it from principal and interest to interest only. That's probably the only time that I have seen it happen where I semi-agree with it. Unless you're an investor, completely different story, and we can talk about that on a different podcast. But that's potentially one thing as well too.
Yeah. I mean, look, I guess, from our point of view, if you can't afford a property on principal and interest repayments, you probably shouldn't be buying that property. Because if it's on interest only, it's going to convert to principal and interest at some point in time anyway. So yeah, I guess that's where our personal stance lies. On that same vein, and in that same vein is when a bank is assessing whether you can purchase a property, the one hurdle is the deposit, the other hurdle is serviceability. So can you actually afford, in the bank's calculations, can you afford to maintain that mortgage? That's called serviceability. So even though you might have a 20% deposit, you might not be able to borrow that amount of money because the bank says, no, based off your income and some other statistics that we're going to throw into the mix, you can't actually afford the repayments on that type of property. As we spoke about earlier, your own affordability measure is imperative. So bank says you can afford the repayments, bank says you've got the deposit. That is based off a statistical average. That is based off a bank's metrics. It does not mean that you can afford those repayments. It means that an average person in a similar boat should be able to make those repayments. So do your budget. Understand what your expenses are. Understand whether you can afford this property, and not just afford the property. Because as you said, like what's your plan? Is it, I'm going to buy this property, I'm going to make principal and interest repayments for the next 30 years and that's it? Or is it, hey, I actually want to pay this off quicker? Or is it, hey, I actually want to build my wealth outside of this and I need surplus cash flow to do it? So, and we've seen it more recently. So I think that when we spoke about it in the past, it kind of fell on deaf ears. Whereas now it's a lot more real and it's a lot more tangible for people. It's based off today. You know, the cost of living goes up. If interest rates go up, where's the buffer? Make sure that you've got a buffer to say that, hey, if something changes, I've got some wiggle room in there and I can still afford to do all of this.
Well, that's what I was saying in terms of getting the deposit up only gets you to the starting line. Yeah. So the game hasn't even started yet. Yeah. Yep. No, well said, Andrew. Consider a buyer's advocate. That's definitely one that I think is worthwhile to make sure that you are buying a good quality asset where you are going to experience capital growth, especially if it's your first home. It tends to help with the emotional roller coaster that you go through as well too, but you're paying, and a lot of buyers advocates do have entry level pricing as well too. So you can get it. It is obviously thousands of dollars, but in saying that, the result that you get is far greater than if you did it yourself. And then in the same breath, in the same vein, when you are bidding, assuming that you are bidding at auction, is setting yourself a price limit when you're doing it so you don't get carried away. And then all of a sudden you said, okay, we were going to stop here. That was our limit. Now we've gone to here and it's like, oh crap. How do we close that gap? What have we done? And if you're at an auction, you can't back out of it. It's done.
Yeah. Yeah. So make sure that you set a limit. Otherwise, yeah, I've seen scenarios where there's, phone calls to parents and in-laws and cousins and friends and, hey, I need some money quickly. But no, absolutely set a limit when you're bidding. I think building and pest inspections is another one. Yep. I mean, it's all good and well to look at a fancy property and it looks great and everything looks fantastic. But if you don't have the expertise to look at, okay, is this structurally sound? Is this going to end up costing me more money in the future? Are there any other things that I need to be aware of? Do I need to factor that into the price? So sometimes it's, hey, yes, this property does have, some issues either from a building or a pest side of things, but I'm going to knock off $50,000 in the price and it's going to cost me $15,000 to fix. So yeah, it's worthwhile. Yep. Let's go ahead, but making sure that you're getting building and pest inspections on the property as well.
Absolutely. Contractor, lawyer or conveyancer to review the contract. So making sure that you understand, which the truth is we don't, so we need it explained to us, but the contract of sale and the Section 32 specifically, making sure that somebody has gone through it who is a professional who can explain that to you, because there can be certain things in the contract that you'd gloss over, you would not know what it includes. But if you're spending that much money, you want to spend the time, effort and energy, put the investment in, get the contract read and get them to explain that to you, just in case there's something in there that adversely impacts the property and by extension, your decision whether you purchase that property or not.
Yeah. And I guess, when you are comparing and contrasting, a conveyancer versus a lawyer, a conveyancer can take you through the purchase and can take you through settlement. But if there's any issues after the fact, then you're almost on your own, or you do need to, find another lawyer or find someone to then take charge if there's any issues. Mm-hmm. Whereas a lawyer does have the expertise in that if there are any disputes, if there is anything that needs to, occur afterwards, a lawyer can take you through that. So sometimes a consideration is maybe I pay that little bit of extra money to a lawyer for that additional expertise.
Yep. Probably lucky last from my end, Andrew, is just making sure you've got your insurances in place. Yeah. In the event that something happens, you want to maintain your financial position from the household's perspective, whether that be lump sum covers like life and disability insurance, or it could be things like income protection. Real simple to do, real simple to get, easy to overlook. relatively cheap in terms of what it is that you're trying to protect, the integrity of your family's financial position. Get that done, tick that box, sleep better at night.
Exactly. And sometimes some of the limitations are, I'm funding a new mortgage. I can't necessarily afford or don't want to, consider then paying insurances or anything out of pocket when I don't need to. So, maybe some of the considerations is for a period of time you fund that out of super. That is an option that's also available, has its own implications, and, you need to work through that with an advisor. But it does give you at least a bit of flexibility from an insurance side of things.
Cost of doing business, Andrew. You wouldn't buy a car and not insure it, would you?
Yeah.
So you should be factoring that in. But Andrew, I reckon that wraps it up nicely. Thanks for today's podcast.
Thanks very much, Bills. Appreciate it.
To our viewers and our listeners, thank you. Much appreciated. Hope you got a whole heap of value out of the podcast. Please like, subscribe, share with family and friends. If there's anything that you wanted to have a chat about that resonated, feel free to reach out to Andrew and myself, and we'll catch you on the next one.
Thanks very much.
Thanks. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.